Three things that stand out. The first is that we allowed for the first time in 2015 retirement funds and pension funds to invest in equities. I don't think anybody realized the potency of that shift, which happened in early 2015. It started with a very humble 5% number. It's today at 15. It probably is going to go to 25% in the next few months. That's in the debate. But what it has done is it triggers a $2 billion buying from retirement funds every month. They show up. Because India has only net inflows into retirement funds. Only 10% of our population is past the retirement age, and every year we are adding 3-4% to our workforce. So we have a very big balance in favor of people joining the workforce. Even if some of them remain unemployed, we're still only adding balances to our retirement funds, and incrementally 15% of that comes into the equity markets. That power of that bid has been so important for the macro shift that has happened in India. So the first thing it has done, it has created domestic pool of risk capital. So hitherto, we always relied on foreign investors to provide risk capital. If somebody in India wanted to set up a project, you would knock on the doors of a foreign investor, give me the risk capital, because there was no risk appetite in India. And I think I was talking to Devin here, we went back to 1992, because people should have that context. In 1992, just before the scam, households in India were investing 25% of their annual saving into equities. Okay? So this year, household saving on an aggregate will be about $750 billion. 25% of that is almost $200 billion. What we are getting today is only 50 billion. We're still a far cry from what we had seen in 92. Imagine if retail investors bought $200 billion of stock in a single year. What would happen to the market? So we are just getting back. We lost 2 decades because of the scam, because a whole generation of investors lost their appetite to buy stocks. Remember, after the scam, the stock markets were down more than 60% in a very short span of time. So the losses were very, very deep, and the wounds were, it took a long time to heal. Now that whole generation has gone past. A new generation of investors are looking at equities, and I keep telling people that we are hardwired to trade. If you go back a few hundred years, India was the largest trading economy in the world. We are actually at heart entrepreneurs, and we like to take risk. We lost our way somehow because of what happened in the markets in the early 90s, and now we are coming back. So this is a secular story which is here to stay. We wrote about this in 2015, 2017. In 2019, we actually drew lessons from US history. In 1980, Ronald Reagan had allowed 401k plans to invest in equities, very similar to Prime Minister Modi's change of policy in 2015. After that, there was a 20-year run on domestic flows into US equities. So we are just at the beginning. That's the first one. The second is the emphasis on FDI. That has completely altered India's ability to withstand oil prices, US recessions, and run a relatively independent monetary policy. So if you go back to the previous bull market of 03-08, FDI flows were $40 billion, FPI flows were $50 billion. In the last 8 years, FDI flows are $550 billion, FPI flows are $45 billion. We no longer rely on FPIs to fund deficits. And FPIs can be very sensitive to oil price shifts, which is why when the war broke out in February, a lot of investors said India is going to sink now because oil prices are going to go up and it's going to be very terrible. Nothing happened because the funding remained. And as you can see in the last quarter's BOP numbers, we surprised on the upside. The third change is the emphasis on corporate profits. That happened in 2019. The government came one fine morning and cut corporate tax rates, and through the COVID period has not lost focus that the deal is to boost corporate profits so that they can invest. If they invest, they can create jobs. If they create jobs, they can create wages, and you will get general prosperity. That prosperity only goes once unproductive investments take root, which takes 5-7 years. So we are in this cycle where I think we should get pretty healthy profit ratios to GDP. It had gone all the way down to 2%. The previous peak was 7. We're now at 4. I think we'll probably go past 7 in the next 3-4 years. If you do the simple math, If nominal GDP growth is 10-11% and profit share in GDP doubles in 4 years, we get a 20-25% compounding in earnings, which means the Indian equity market is trading at 7 times earnings, and it's the cheapest stock market in the world. And foreign investors just about realizing this.